Imagine a company full of buzz, promising to revolutionize how we work, reaching an astronomical valuation of $47 billion. Then, almost overnight, that entire illusion crumbles, and its much anticipated public offering evaporates. That, my friends, is the story of WeWork, a saga that epitomizes the perils of unchecked ambition and, more critically, profound governance failures. We're not just talking about a bad business model, we're talking about a system designed to fail under the weight of its own internal flaws. It's a deep dive into how power was consolidated, valuations were artificially inflated, and glaring conflicts of interest were ultimately exposed. In its early days, WeWork presented itself as more than just a landlord. It was a community, a lifestyle, a tech company disrupting the traditional office space market. The pitch was compelling: flexible workspaces, vibrant environments, and a global network for freelancers and startups. This narrative attracted immense capital and captured the imagination of investors who saw exponential growth potential, not just in renting desks, but in building a brand new way to work. It was supposed to be the future, but a closer look reveals a foundation built on shaky governance. At the heart of WeWork's governance issues was its charismatic, yet controversial, co-founder, Adam Neumann. From the very beginning, the company's structure was designed to grant him extraordinary control. This wasn't just about being CEO, it was about an ironclad grip over the board and strategic decisions, thanks to a very specific mechanism: supervoting shares. These weren't standard shares, they were shares that carried disproportionate voting power, effectively sidelining other shareholders and board members. It's wild to think one person could have so much sway. So, what exactly are supervoting shares? Imagine typical shares give you one vote each. Supervoting shares might give you 10, 20, or even 100 votes per share. In WeWork's case, Adam Neumann secured shares that amplified his voting power significantly, creating a dual-class share structure where his voice effectively dwarfed everyone else's. This meant that even if he owned a minority stake in terms of capital, he retained outsized control over critical decisions, board appointments, and the company's direction. It fundamentally undermined the principle of balanced governance. With supervoting shares firmly in hand, Adam Neumann had outsized board control. This wasn't a subtle influence, it was a near-absolute authority that allowed him to steer the company without significant challenge from other board members or institutional investors. This structure essentially eliminated the traditional checks and balances crucial for a company of WeWork's rapidly expanding size and ambition. It meant fewer independent voices, less critical questioning, and a greater propensity for decisions that primarily served the founder's vision, rather than necessarily the company's long-term health or shareholder value. Enter SoftBank, the Japanese multinational conglomerate led by Masayoshi Son, known for its audacious investments in disruptive tech companies. SoftBank saw WeWork as the next big thing, pouring billions into the company. Their initial capital injections in 2017 were substantial, giving WeWork the fuel it needed to expand globally at an unprecedented pace. This was the start of a massive investment spree that would fundamentally alter WeWork's trajectory and, as we'll see, its valuation, often detached from its underlying financial performance. SoftBank's significant capital injections immediately began to inflate WeWork's valuation. Each new round of funding, backed by SoftBank's deep pockets and bullish outlook, propelled the company's worth higher and higher. This wasn't necessarily driven by a proportionate increase in revenue or profitability, but rather by the sheer volume of investment and the market's enthusiasm for perceived disruptors. It created a feedback loop where investments signaled success, which attracted more investment, pushing the valuation further into the stratosphere, disconnected from the core business fundamentals. Between 2017 and 2019, SoftBank's capital injections weren't a one-off event, they were repeated, massive infusions of cash. This consistent flow of money allowed WeWork to continue its aggressive expansion, opening offices in cities worldwide. However, this period also saw the valuation grow at an astonishing rate that simply didn't align with the company's revenue fundamentals. The business model, while generating revenue, was also burning through cash at an alarming rate to support its rapid growth, creating a widening gap between perceived value and actual financial health. By early 2019, riding on the back of SoftBank's relentless funding and ambitious projections, WeWork reached its zenith, a staggering $47 billion valuation. This placed it among the most highly valued private companies globally, a unicorn of epic proportions. At this point, the narrative was almost unshakable. WeWork was a tech giant, not a real estate play, and its potential was limitless. But beneath the surface of this impressive number lay a fragile reality, thinly veiled by venture capital and the hype surrounding its founder. Here's the stark reality: while WeWork's valuation soared to $47 billion, its revenue fundamentals simply couldn't keep pace. The company was spending heavily to acquire new properties, renovate them, and offer incentives to tenants. This meant huge operational losses, year after year. The market was valuing it like a software company with high margins and scalability, but its business was fundamentally real estate, with all the associated capital expenditures and slower returns. This mismatch was a giant red flag that many, especially those caught up in the hype, chose to ignore. For a company of WeWork's size and ambition, an initial public offering, or IPO, was the logical next step to raise even more capital and provide liquidity for its early investors. The process requires filing a detailed prospectus with the U.S. Securities and Exchange Commission, known as an S-1. This document is meant to provide transparency, giving potential public investors a comprehensive look under the hood of the company's financials, operations, and governance. It's a moment of truth, where the private valuation meets public scrutiny. In August 2019, WeWork officially filed its S-1 document. This was supposed to be the triumphant reveal, paving the way for one of the year's biggest IPOs. Instead, it became a forensic examination of the company's inner workings. What followed was an unprecedented level of public and investor scrutiny that quickly turned from admiration to alarm. The S-1, a document designed for transparency, inadvertently became a comprehensive exposé of the company's questionable governance and, specifically, Adam Neumann's deeply entrenched conflicts of interest. The devil, as they say, was truly in the details. The S-1 filing laid bare a series of significant conflicts of interest, all pointing back to Adam Neumann. These weren't minor oversights, they were structural issues that blurred the lines between his personal interests and the company's. For public investors, this was a huge red flag. It raised serious questions about fiduciary duty, ethical leadership, and whether the company was truly being run for the benefit of all shareholders, or primarily for the enrichment and convenience of its founder. This lack of clear separation was a major blow to investor confidence. One of the most glaring conflicts revealed was Adam Neumann's personal real estate dealings with WeWork. He, quite astonishingly, owned properties that he then leased back to WeWork. Think about that for a second. The CEO of a massive company was also its landlord, collecting rent from his own business. This arrangement raised immediate concerns about self-dealing. Was WeWork securing the best lease terms? Or was it overpaying to benefit its founder? It's a textbook example of how personal interests can directly clash with corporate interests, and it screams bad governance. Perhaps even more bizarre was the revelation concerning the We trademark. Adam Neumann personally owned the trademark rights to the word we, which was central to the company's branding: WeWork, WeLive, etc. Then, he sold these trademark rights to the company for a reported $5.9 million. Yes, you heard that right. The founder sold an essential part of the company's identity to the company itself, for millions. This wasn't a strategic acquisition from an external party, it was an internal transaction designed to benefit Neumann directly. It was a move that baffled and angered many. Beyond these specific examples, the S-1 painted a broader picture of chaotic governance. There were instances of Neumann taking out personal loans backed by WeWork stock, family members holding key positions without clear qualifications, and a general lack of independent oversight. These weren't just details, they reflected a deeply problematic corporate culture where the lines between founder, CEO, and company assets were consistently blurred. It suggested a company run more like a personal fiefdom than a mature, publicly tradable entity. Investors were not amused, to say the least. The revelations in the S-1 filing triggered a massive public backlash. Media outlets, financial analysts, and potential investors all began to scrutinize WeWork's business model and governance far more aggressively. The narrative shifted dramatically from disruptor to disturbing. Questions mounted about the company's path to profitability, its exorbitant spending, and the ethical conduct of its leadership. The hype rapidly dissipated, replaced by skepticism and outright alarm. It was clear that the emperor, or in this case, the We brand, had no clothes. The supervoting shares, the real estate deals, the trademark sale, these issues collectively shattered investor confidence. Public market investors, unlike some venture capitalists who might tolerate more founder control for hypergrowth, demand robust governance, clear ethics, and a predictable path to profitability. WeWork's S1 showed the exact opposite. The risk profile dramatically changed. What once seemed like a visionary investment now looked like a high-risk gamble burdened by a problematic leadership structure. The $47 billion valuation began to look less like a triumph and more like a fantasy. As the S1 details became widely known, the market's initial enthusiasm for WeWork's IPO quickly soured. Underwriters, the banks responsible for bringing the company to market, found it increasingly difficult to convince institutional investors to buy shares at anything close to the private valuation. The projected IPO valuation plummeted, with reports suggesting it could be less than half of its peak. This wasn't just a slight adjustment, it was a fundamental rejection of the company's valuation thesis, directly driven by the governance concerns and the lack of a clear path to profitability. The pressure became insurmountable. Faced with dwindling investor interest, a collapsing valuation, and intense public scrutiny, WeWork had no choice. In September 2019, just weeks after its S1 filing, the company formally withdrew its IPO. This was an unprecedented move for a company of its size and perceived stature, marking a spectacular failure for what was once hailed as one of the most anticipated public offerings of the year. The dream of going public, of validating that $47 billion valuation, was officially over. With the IPO withdrawn, the house of cards began to collapse. The $47 billion valuation, once a symbol of WeWork's supposed success, effectively vanished. Investors, especially SoftBank, were forced to re-evaluate the company's true worth. The reality hit hard. Without the public market's endorsement, and with all its governance flaws exposed, the company was worth a fraction of its former glory. This wasn't just a market correction, it was a complete repudiation of the valuation model that had been sustained by private capital and fervent belief, rather than solid financial performance. The spectacular failure of the IPO and the subsequent collapse in valuation naturally led to calls for accountability. Adam Neumann, the architect of WeWork's unique culture and its governance structure, became the central figure of blame. Under immense pressure from investors, particularly SoftBank, he was eventually forced to step down as CEO in September 2019, the very same month the IPO was pulled. His departure marked the end of an era for WeWork and a clear signal that the company needed a radical change in leadership and governance to survive. SoftBank, as WeWork's largest investor, found itself in a precarious position, facing massive write-downs on its investment. To stabilize the company, SoftBank had to inject even more capital, effectively bailing out WeWork and increasing its stake significantly. This rescue package came with strings attached, primarily demanding stricter governance, a more traditional board structure, and a drastic overhaul of the company's spending habits. It was a costly lesson for SoftBank about the importance of oversight, even in the most promising disruptors. The WeWork saga offers critical lessons in corporate governance. The story highlights the dangers of concentrated power, especially when a founder's vision is left unchallenged by independent board members. It underscores the importance of a clear separation between a founder's personal finances and the company's assets. And it forcefully reminds us that transparency, accountability, and ethical conduct are not just buzzwords, they are fundamental pillars of trust, especially when a company seeks capital from the public markets. Ignore them at your peril, or at the peril of billions in valuation. The case of WeWork firmly put the spotlight back on the controversies surrounding supervoting shares. While some argue they allow visionary founders to pursue long-term goals without short-term market pressures, WeWork showed the dark side, unchecked power leading to self-serving decisions and a disregard for broader shareholder interests. It forces a conversation about whether the benefits of founder control outweigh the risks of governance lapses. For WeWork, the answer was a resounding no, resulting in a spectacular collapse rather than sustainable innovation. SoftBank's role in WeWork's inflated valuation is also a critical takeaway. Their repeated capital injections, while fueling growth, also effectively shielded WeWork from market realities for too long. By continuing to pour money into a company with fundamental flaws and questionable governance, SoftBank inadvertently contributed to the problem, allowing the valuation to balloon without commensurate improvements in profitability or structure. It highlights the power and potential pitfalls of venture capital when due diligence on governance might take a back seat to the pursuit of exponential growth. Following the IPO withdrawal and Neumann's exit, WeWork embarked on a painful restructuring. New leadership focused on cost-cutting, divesting non-core assets, and trying to return to its roots as a flexible office provider, rather than a nebulous tech company. The valuation stabilized at a significantly lower level, a stark reminder of the market's initial overestimation. It's a journey from hype to humility, a battle for survival that continues to this day, illustrating just how difficult it is to undo years of unchecked growth and poor governance, even with billions in backing. Ultimately, the story of WeWork serves as a stark cautionary tale for both entrepreneurs and investors. For founders, it's a reminder that charisma and vision, while important, must be tempered by sound business practices and robust governance. For investors, it's a lesson in looking beyond the hype and the eye-popping valuations, focusing instead on fundamentals, clear paths to profitability, and, most importantly, scrutinizing the leadership and governance structures that dictate a company's long-term health. Because even $47 billion can vanish if the foundation isn't solid.